All right, everybody, welcome back to the Audit Cast. As usual, I'm going to jump right in. So, first and foremost, I want to talk about the assertions that tend to take the most time or bear the most risk, or are kind of what you're going to be spending the majority of your time working on during your first couple years. So, don't worry about the term assertion right now if it's a little foreign, because I think by the end of the episode, you'll have a pretty good grasp of it. So, without further ado, those assertions are completeness, existence, accuracy, and valuation. So those are going to be kind of your most important ones for the next couple years. There's definitely risk in the other assertions, and I'm not trying to downplay that. However, these are the assertions that tend to take the most time for now. So here we go. We'll get right in with completeness. So completeness is the idea that a balance is complete, right? Makes sense. But it's kind of like, the other way to say that is to make sure that there's nothing missing from an account balance. For instance, in AP, if you want to make sure that a balance isn't lower than it should be, you have to do testing for completeness. So how would an AP account be lower than it actually should be? So imagine a 1231 client gets a new printer that costs $500 on December 15th. So remember the fact pattern. They're at 1231 year end, December 31st year end, and they bought a printer on December 15th, so 2 weeks before year end. But the printer company hasn't asked for monies as of 1231, so they haven't invoiced your client yet. And if the client doesn't put that $500 in their AP listing, then their AP listing would be considered understated and it would be incomplete, right? Because there's an invoice that didn't actually make it into their AP listing. So I think completeness is a pretty simple idea. It's not just used in terms of dollars. It can be used in an attribute sense too. If a listing's missing key data inputs, or if, for instance, like a headcount listing. A headcount listing is a listing of all employees for either a specific department or company or whatever. And if that listing has every employee in there, like it should, like they would expect, then it's complete. But you need to do testing to ensure that it's complete. So the next assertion we'll jump into is existence, accuracy, and valuation, kind of in combination. I like to combine these and use inventory as an example, because it's kind of simpler to understand that way. So I break it down into a simple equation. Quantity times cost minus reserves gets you to existence, accuracy, and valuation of inventory. So let me say that again. In terms of inventory, it's kind of a simple equation. There's quantity times your cost less reserves gets you to EAV of inventory. So, and I'll detail this further, so don't worry. So imagine inventory, right? There's a certain number of items, like inventory items on hand, times the cost of these items, the company's cost for these items, which I'll call the nominal value. But there's a piece of this that, the piece of the nominal value that isn't correct because things get damaged, they're not valuable because they won't be selling in the future, a lot of different reasons. And so a reserve must be set against them. So that's essentially to offset the piece of that nominal cost to make sure it's correctly valued. So in this case, quantity, in our example case, I should say, quantity equals existence, cost equals accuracy, and valuation equals the reserves. So let me say it all over again. Quantity times cost minus reserves gets you to EAV of inventory. And quantity being existence, cost being accuracy, and valuation being the reserves. So I think that's kind of a straightforward way to look at it. And this can be applied across different account balances, but I'm just trying to get you the concept for now. So let's go with one more example. Let's talk fixed assets. So do fixed assets exist? That would be a question, right? That'd be a risk. Yes or no? So in determining in determining that testing, in doing that testing, the evidence you should get should support that a fixed asset does exist. So that's kind of the E assertion for fixed assets. And then to determine the full asset value, excuse me, let me back up. In determining the full asset value, you need to figure out if there's any damaged or impaired assets, which kind of gets you to valuation. The accuracy piece here is just the cost of the fixed asset being put in place. So again, in this case, it's going to be your existence. Does the asset exist or not? And do the number of assets they have on their books exist or not? So that's kind of a quantity, right? Times their cost, like their invoice cost, or however they got billed for it. Maybe it's a big building, so they're not necessarily invoices, but contractor bills or something. And then the less valuation piece is anything that's impaired from a building perspective, or not going to have future revenues associated with it. That piece of the valuation testing is a little trickier for fixed assets, so we can save that for a different one. But essentially, the valuation with fixed assets is how do we say this? Without going into a full-winded definition here, so fixed asset is propped up on the balance sheet because it is expected to have future cash flows associated with it. That's any asset, right? It's there because it's going to generate future revenues, similar with inventory and other asset balances. It's not going to be it's not necessarily going to be sold within a year or whatever. So if we stick on the example of future cash flows associated with an item, let's say a company has a machine that makes car tires or something. I don't know, melts rubber and turns it into car tires. I have no idea how car tires are made, but let's just say there's a machine that does this. And so that machine might have cost 10 grand and it has a 10-year life, whatever. So that machine having 10 years of useful life, and they're expected to have inventories made with that. Inventories made from that machine that they can sell in the future. That would mean that there's cash flows associated with that machine. However, if that machine was expected to be able to make 10 tires a day, but it's damaged and now can only make 5 or something, there needs to be a consideration of impairment. Anyways, that's really long-winded and not the point of this. We're talking about existence, accuracy, and valuation, which I think kind of gets you full circle back to understanding those, the E, A, and V assertion. So if that's not clear enough, please reach out. Let us know. Twitter, Facebook, all that stuff. I'll give you all the links at the end. So some of the other assertions you will deal with are presentation and disclosure, which essentially means are the balances correctly incorporated in the financials or listed in the financials in the right way. For instance, like you wouldn't want to call cash a long-term asset. So the P&D assertion or risk associated with that assertion for cash is that it's just that cash wouldn't be classified properly. Something else to remember is that not all firms follow the AICPA or PCAOB assertion listings exactly. Like they may call things a little different, or they might group a couple together. So don't be thrown off if my listing of assertions is a little bit different than your firm's, because they're all captured within, like, all the AICPA or the prescribed assertions are all going to be considered by your firm. It just might be written a little differently. So here's another quick tip too for the rights and obligations assertions. They're generally not a relevant risk as it pertains to P&L accounts. So as it pertains to the income statement, just because rights and obligations typically are related to assets and liabilities. Makes sense, right? So, all right. So I want to go back to completeness just for a second, because this assertion is often tricky because your senior, your manager, they'll always ask, how did you get completeness of this listing? Say you're doing some test work and you have a listing and you want to just pick your samples or agree something to that listing, and your first thing your superior is going to ask is, how did you get completeness over this listing? Because there's possibly a risk of understatement or inaccurate records due to incomplete listings or whatever. So get this concept down, the concept of completeness down quick, because it will help you find ways to get comfort over the completeness assertion in creative ways, I guess. And I hate to use the word creative in anything accounting related, any kind of podcast or realm that's accounting related, because it has those two words typically don't belong together in any kind of accounting related sentence. However, there's always more than one way to audit something. And so that's what I mean by get creative. Like think how you can get completeness over X, balance, listing, population, whatever. Think about that after you've got a good grasp of what completeness is, because that will help you. Like maybe you've tested another listing somewhere that has all the data that you need in it, so you can agree your listing to that one. Or you can kind of do negative completeness, so to speak. I don't know the proper term for that, but essentially where you go, okay, well, here's the whole population, so I'm going to pick things that shouldn't be in my listing. And this gets a little detailed right now, but the point is, just understand that completeness is a fairly simple assertion to wrap your head around, and I think it will help you going forward, because you will get those questions. How did you get completeness? Did you tie out your balance to the GL? Did you tie your listing to the lead sheet? So on and so forth. So I hope this helps. If you guys have any questions, please reach out. There are a million ways to get a hold of me. We have a Facebook fan page, or I don't know what it's called. Maybe it's a fan page. It's facebook.com/theauditcast. There is our website, which is theauditcast.com. We have a forum, which you can post anonymous questions to. We have a Twitter account @theauditcast. Instagram, same thing, @theauditcast. So just find us, ask your questions. I'll respond as soon as I can. Also, we're trying to build a community here so that there can be kind of some knowledge sharing too on those platforms. So also rate and review this podcast. That really helps to kind of get feedback on our end, to know how we're doing, what you guys want changed, anything else you'd like in the podcasts, any specific topics, so on and so forth. So I think iTunes has a good rating, simple way to rate. I don't know about the rest. Maybe Stitcher and Shout Engine, the actual host of the podcast, they have some kind of rating for them. Anyways, thanks a lot, guys. Hope I didn't take too much of your time. Hope this helps. Later.